What's going on, everybody? 360 Digital Closing Bell here. I am your humble correspondent, Michael Tanner, here for our Week Ahead podcast here on this beautiful Monday, June 22nd, 2020, for episode number 27. As always, I'm joined by the executive producer of the show, the publisher and director of the world's greatest website, oilandgas360.com, Stuart Turley. How you doing, my man?
I'm doing fantastic. It is a Monday, and we're going to have a busy week.
We have a pretty busy week. We're actually recording this for the first time on a Monday morning. Time stands at about 7:53 a.m., so markets are open. Oil's trading about $39.80. So a little off the open last night, but we have a wild show for you guys lined up. We're going to talk to you, obviously, about the crude oil levels, commitment to traders, checking with the 360 official, non-official fund, and sort of dive into my Shale 1.0 thoughts for the open here. But before we do that, please, guys, if you are working and are executive in the oil and gas field and you are not asking yourself, what is social risk for the energy sector? You're really doing yourself and your company, and specifically your shareholders, a disservice. It's not just community opposition to development projects. It's everything from the success of the divest from fossil fuels movement to investor engagement on your ESG programs to individual states setting extremely ambiguous climate and decarbonization agendas. Social risk seems like it's everywhere now, moving fast and multiplying like zombies. And if you know anything, if you played any sort of Call of Duty, you know zombies, boom, pop out of nowhere. You should please check out Adamantine Energy. They're the leading consultancy helping oil and gas companies prepare for all of this social risk. They're led by Tisha Schuler, who's the former CEO of the Colorado Oil and Gas Association, COGA. Ever heard of it? Adamantine Energy guides energy companies like yours to help explore your exposure to social risk, your options, response, how your peer companies are responding, and the tremendous opportunities social risk can actually create for your business. You should check out everything Adamantine Energy, www.energythinks.com. You can also read Tisha's weekly emails where she's keeping everyone updated on what's on the horizon for the oil and gas sector. Remember, your competitors are reading that newsletter, so you need to be reading it. Also, check out her podcast, Energy Thinks Podcast by Tisha Schuler. Again, everything you can find, just Google Energy Thinks. That's her tagline. Also, guys, just please subscribe to this show, iTunes, Spotify, YouTube. Subscribe, resubscribe, download all the shows, undownload them, re-download them again. Do whatever makes the algorithm go nuts. We really appreciate all the support we've had, and we are fired up. You can also check this out on YouTube. You can check out all things Oil and Gas 360 on Twitter, LinkedIn, Facebook. We are on every social. We're posting every single day. We've seen some tremendous engagement over the past month in terms of an increase, so we really appreciate everybody who has interacted with us. You can also check out all of Enercom, Oil and Gas 360, on Twitter, LinkedIn, all of the socials. Check out the Oil and Gas 360 news desk, which is on the world's greatest website, oilandgas360.com. I'm telling you, it's the one-stop shop for all of your energy information. I just put my weekly charts up there. We have a running news feed. You can check out all of the previous shows, which has the daily digital ticker shows that we do. They're like 10 minutes. We go live on YouTube every single day for 10 minutes, bringing you information about what's going on in the market. So we appreciate everybody who watches that. You should also listen to the Energy 360 interview podcast by Intercom, which is basically the best place for energy thought leadership. The amount of I'm talking the quality of guests that they've been getting are unbelievable. And we have a powerhouse interview that's dropping tomorrow.
That is right, Michael. We have Rob, President and COO of Goodrich Petroleum. And I think we got another one on Wednesday, Jeffrey Ken. He's an author. And Canadian. So we love our Canadian brethren.
No, dude, I thought you said comedian for a second. I was like, oh, interesting. I thought he was an author of a digital technology book, but then I put two and two together with Canadians. We love our friends north of the border. Jeffrey Cam wrote Bits, Bytes, and Barrels. It's a great book. You can also check out his digital technology training course on Udemy. But Rob Goodrich, the interview that drops tomorrow with Rob Goodrich of Goodrich Rome, who's the president and COO. If you want to know sort of what just kind of a high level when an executive thinks about maybe some of the top things going on in his business, please check out this interview. It'll be available probably about noon tomorrow, I'd say, maybe Mountain Standard Time, and you can check it out on all the platforms and the world's greatest website, oilandgas360.com. Whew. Enough with the clerical work. If you're looking at the charts this week, I'm definitely bearish on oil, but we'll get into that. Before I sort of tell you why maybe I'm bearish, I just need to I've been seeing a lot of articles that get dropped. And if you spent any time on Twitter or LinkedIn in the oil and gas sector, I think you're beginning to hear what's sort of called the end of Shale 1.0 and the beginning of Shale 2.0. If we've covered on this podcast many times, there were problems with Shale before COVID. and COVID just exacerbated them. If they were small to medium issues, now this price collapse due to this absolute demand destruction from everybody staying home exacerbated the problem, and now they are large problems. And we've seen a record number of Chapter 11. It's pretty easy to see how in the next 6 to 9 months, there's going to be a tremendous period of change within oil and gas, and specifically where capital is going to be spent and where it's not going to spend. And if you've listened to the show at all, you know exactly where we think capital is going to be spent: ESG, and low-cost energy sources. So I mean, we're not hiding where we think the capital is going to be spent. But even if we don't think, even if we or leave that up to chance, point is capital is going to be spent differently than it was spent pre-COVID. Whether or not it ends up being spent on ESG and all of this stuff that maybe we lean towards, it doesn't matter. And so because of this change and because of this sort of death, and I'm doing that in quotes, of Shale 1.0, you're seeing the obituaries being written right now, and the numerous articles, Wall Street Journal, Reuters, I mean, Bloomberg Terminals, lighting up with stories of people writing the happiest obituaries for Shale 1.0. Because, I mean, by and large, their thesis is the exact same. There's no multiple theory. The only theory about why Shale, or not theory, but the only reason why these guys are happy is because, in large part, Shale 1 was seen by them as a capital destructor as a whole. And I think that was the sentiment. You know, I think if you pulled the industry 2-3 years ago, maybe it was a small fraction, maybe 10 to 20% of the people who would have held that point of view. I think the closer and closer we got to 2020, I think the number increased till, I think now with COVID, people now being inside and sort of being exposed to, I mean, the internet is what made these people aware of maybe what was going on. I think that I think the segment of the oil and gas industry, which is happy to see the Shale 1.0 version of the way it's a business, I think they're excited to see it go bust, caving in on itself, come back and rebrand itself, because as they say, by and large, it's sort of been a capital destructor. But if you follow the show, you know I'm a contrarian. People have been calling $4 gasoline next year. I don't know about that. I'm not sure if gas is, I tend to take the opposite view because it's just sort of how I was bred. So I'm beginning to see this ball. I mean, think about the Newton balls. They tink, 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 tink. I think they're swinging way far into this happy obituary. Shale 1.0 is dead and I think we're beginning to miss really what 1.0 did for not just the oil and gas industry, but the economy as a whole. And I think that's the distinction that I think these people are forgetting to make, is they're focusing too much on just the oil and gas industry, which obviously we're in the oil and gas industry, but sometimes you have to take a step back and take a look at a macro view of things. And so I think before I dive into that a little more, I think it's helpful to define these terms, because maybe you don't know what Shale 1.0 and Shale 2.0 is. And to be honest, they're subjective terms. So that's why I want to go over them, because I want you to know what I'm thinking when I say these terms. So when I talk about Shale 1.0, I'm talking about 2008 to 2020, or specifically COVID. And you can even split those up. And when we dive into Shale 1.0, I'm going to split them up into two halves. But really, it was defined by three things: fracking, unlocking of places like the Bakken, the Haynesville, which then led to an insane gas boom. I think, correct me if I'm wrong, Stu, if you had to pick three sort of overarching themes besides maybe capital destruction or just massive, I think, fracking, the unlocking of places like the Bakken that led to this huge gas boom. I think those are the overarching stories in that, 10 to 12 years.
You bet. And the third one, the U.S. becoming a world power by exporting. So I think we will continue that in the natural gas space, with LNG still pounding out very large exports.
Yeah.
But the world power was probably number three.
Yeah, and you bring up a good point, because in that time period we became not energy independent, but we became one of the world's largest producers. So again, but that was because of fracking. So that's why I put fracking sort of as the first thing, because that is sort of what led to a lot of this. And Shale 2.0, excuse me, well, that's just COVID to I don't really know. Who knows? Because there are a lot of theories out there right now about what Shale 2.0 is going to look like, but they're just theories right now. I mean, I think the consensus is offshore and tier 1 Permian might be the only profitable fields. I know we at Enercom Oil and Gas, we're really big on capital is probably only going to be spent on things that are sustainable, have an ESG plan, and that fit this entire corporate social governance policy that is being led by the large investment banks and where the capital comes from. But honestly, I don't really want to discuss where Shale 2.0 is going to go because, pardon my French, but it's just going to be a pissing match. Nobody really knows. This is what I think. This is what you think. It's hard to say. Now we can say, man, maybe it's going to be this, maybe it's going to be that, but it's too much in theory land I think for us to talk about right now. But why I want to make this distinction is because I think we're seeing Shale 1.0 get a continual bad rap. And so going back to one point, I mentioned it's 2008 to 2020. I think you can chop that in half. And what I would encourage you to do while you're listening to this, I will make sure to post the chart onto the show. I would go to TradingView. I would load up a new chart, and I would plot 3 lines. I would plot XOP, which is the SPDR section, the S&P 500 energy section. I would plot the S&P 500 as a total index, and I would plot crude oil price. I would throw the XOP and the S&P 500 on the right axis, change it to a percentage so you can kind of see the percent increase and decrease. I would throw crude oil on the left side and make it, make your axis 10 to 150. Yeah, because you want to make sure you get it all. And I would do about a 5-year time frame so you can get 2008. Or I'd go the 12-year time frame, 2008, 2020. You're probably going to go out through a week time frame, and I change them all the lines. So I will throw my chart up there, but I recommend building it because that's sort of how you figure out how all this stuff works. So if you're looking at a chart, I always say oil price charts read like a history book. Let's just roll through the pricing, and we can figure out. Obviously, in 2008, oil's $148, and that's right before the crash of, right during the run-up of the financial crisis, and then boom, oil goes from $140 all the way down to $40 in basically a matter of months. It's like 6 months if you're looking at the chart. And then what does oil do? Oil recovers pretty nicely, and it goes from 30 to, by basically mid-2009, it's 70. Then it goes 80. Then it goes 90. And then all of a sudden, from a stretch between 2012 and mid-2014, oil's averaging $100. I mean, I remember doing calculations, and you could just average, just $100 oil. It's just easy to do math that way because you could do the math in your head. I mean, that's an unbelievable amount of, you think about oil companies, some oil companies make money now at $40 oil. Imagine if oil was $100, what companies would be able to do in terms of, maybe drilling some unprofitable things and all that jazz. So from 2008 to 2014, we saw an unbelievable, just sustainable in the price of oil. Everybody got rich. What industry was giving out 6-figure gigs to people without high school diplomas? Who was doing that? There's few industries that'll do that right out the gate. Hey, you want to go climb up a derrick and pull some pipe? Yeah, we'll cut you a check. You might have to work night shift, but there's very few industries that were doing that. So, that period was wealth creation for a lot of people. There was within the industry and out of the industry. Well, in 2014, 2015 comes, and this is when the shift from fracking went from fracking oil to now let's go get gas. And the dynamics really changed in the oil business. And this is when I think a lot of people, they hop on and start banging the deuce on why companies like Chesapeake, Continental, why they destroyed the oil and gas business, because they did. They ramped up fracking. They ramped up production, drilled as much as they could, and tanked the oil price. Oil price went from $100 all the way down to $39. Now, this was also due to this was also due to another price war. You really want to talk about the amount of price wars we had going back. So there was a coincidence of America and the United States was at peak production at the time in 2014, peak fracking, peak rigs, and all of a sudden there was a complete drop, boom, in the price of oil. But what happened? We continued to produce. It didn't stop us. We continued to produce. And from 2015 to 2020, oil price basically averaged like $45. You look at a chart, you can kind of chop. And the XOP underperformed 70% compared to 0% so if there were zero gains in the S&P 500 over 5 years, the XOP lost 70% due to that, with the S&P 500 basically being up 105% over that 12-year span. So you want to talk about an unbelievable spread between where oil companies performed and where the S&P 500. But what does that mean? So we saw this complete destruction of the oil price. But we're producing at all-time highs, and the economy is roaring. And this is where I think these people who are writing the obituaries of Shale 1.0, they stop it here. They say, oil prices were high. Price war came in. Saudi came in 2014 and said, no, we don't like this. We want to gain back market share, and they tanked the price. Well, oil companies didn't turn the tap off. If anything, they turned it more. They said, well, the more we produce, the more, we'll just make that other, we can now just pay 40. We have to produce 2 barrels for every 1 barrel. And that was the thought process. We can continue to do this as long as we just double our production. Well, this led to one of the biggest increases in economic expansion in probably the United States history. I mean, outside of maybe the roaring 20s and what happened post, sometimes in the 50s, but in my lifetime, that this 5-year stretch from 2015 really to the beginning of COVID has been one of the most largest economic expansions in terms of in the rest of the economy. And this is where I think people that are writing these obituaries are forgetting about it. Yes, the oil industry from 2014 to 2020 has basically not flipped its business strategy, even though the economics have completely flipped. But what it did was we basically were subsidizing this economic expansion. We were continuing to produce through all of these low prices, through all of these levels. Why? Energy prices were so low that allowed this expansion to happen. So these people that are, so I think it's just this, we're missing a piece of the puzzle. When this obituary is getting written and people are talking about the destruction was the destruction from, we did not shift and we didn't lower production and we didn't balance it out, because there were people arguing there was a way to get oil to $70 if we just kept reining it down, but we didn't. And that caused this economic expansion, and it's this double-edged sword. And I think as we look back in history, we're going to get a better sense of this. I think in the moment it stinks because the oil industry is going through a tough time right now. I mean, there's a large number of people unemployed and who are looking back and probably thinking, man, if they had just been a little more fiscally responsible these last 5 years, I might still have a job. Yes, it might be true, but you also have to, you also got to think about, and this goes back to supply chain. I mean, the economic expansion touches everything. And when I mean economic expansion, I mean, you're paying less for groceries now. You're paying, think about Amazon. Why do you think Amazon is able to deliver things so cheaply? Yes, they've contracted with the Postal Service and they're screwing them out. But also, it's just cheap to transport things now. I mean, they can roll out their own, the energy and access to be able to economically expand absolutely increased during this time. And I think that's just the part that people are leaving out. And I want you to think about when you read these articles on death of shale, death of, good for shale, we need to move on and redo a business model. Well, don't forget that probably the reason why we're standing here is because the fact that guys like Aubrey McLennan subsidized the U.S. economy and U.S. energy prices for years. I mean, you want to think about, it's really true, Stu. I mean, companies like Continental, and these companies who are now maybe going bankrupt and who are now the darling of Twitter for how to not run a company, they legitimately subsidize low-cost energy. And that's the part that people are forgetting.
You bet. And I think there's some real changes coming, Michael, and that is good management, good numbers, but those who cannot morph will die. And we've had on the show, there's 70 ballpark, oil companies, and we're going to get down to 20. So it's going to be acquisitions, bankruptcies. But later on, Alaska, I put over the weekend, Alaska's coal producer, Isabella Mines, expands into biomass. This is a perfect example of somebody that is morphing. And they're morphing into renewables, but they're yet very critical in the coal. Morphing. Another oil field service up in Canada morphed into a geological energy drilling company.
Yeah.
Might as well drill for that. So if you don't morph and you don't have ESG, you will not survive.
No, and this isn't all to say that there's been the energy business has done everything right over the past 5 years. I just think that we're leaving out a big part of the story, which is the 90% of the economy that's not tied specifically to the energy business was completely subsidized by low-cost energy provided by us. So it's like everything, it's a mixed bag.
Yeah, Michael, you and I have talked about a lot of the things coming around the corner, and we're going to have some specials on those and all the impacting things of the oil 2.0 as you've been talking about. I think you and I will be able to define it in better ways coming up in some of our specials.
Oh, definitely. And I think as we move on, as we get more information, I mean, right now, like I said, it's all theories right now, and that's partly why we don't need to get into the pissing match right now. But as we begin to flesh it out, I think we can sort of build an idea of what that looks like. That's really all. I mean, I just needed to get that off my chest. It was killing me reading all these articles, and nobody was talking about what happened to the other 6/7 of the economy due to that. So I just need to get. Is there anything you need to say on that before we move on?
We got the specials coming on, but there's also a regulation that came out over the weekend, and that is they've authorized widespread transport of LNG by rail. That is huge.
Yeah.
That is going to fix some of the Marcellus gas coming around. It might be able to affect some of the stuff and flaring in the Permian. It is huge. We might be able to import more from Canada. That's a game changer by rail. So,
Yeah,
anyway,
no, rail will be something that's definitely interesting that we're going to follow. But I think it's time. Let's go ahead and just dive into the oil levels here for the week. As always, this segment is sponsored by Sandstone Capital Group. These guys do insanely good research and provide all of their levels from the Energy Glimpse solution. Give them a call, 949-561-1818, or check them out, sandstonecg.com. I mean, really, there's two things I'm looking for just on the U.S. shale side this week, specifically. Last week was debt, was bankruptcies, and when we were looking at what was going to happen. This week, I think it's production. I think we're going to start hearing drips of production coming back online. We've heard some squabbles. Continental's bringing back 25% of their shut-in production. We ran a story last week where ConocoPhillips is turning on all of their Alaska production. That's like 500,000 barrels they're bringing back. Good for Alaska. They'll get some of those people back to work. But I think we're going to start seeing some of these numbers. And, I think the question is it too fast? Only time will tell. No one knows how the market, I think, is going to react right now. I mean, as we speak, oil's just spiked over $40. So, we ran a story on Friday where, small stripper operators, $5 change in the price of oil, 40 to 35, leads to basically 33% of a credit draw on their RBLs. So, you want to talk about the fine line that gets walked when you produce this stuff. That's what we're leaving at. So if oil stays at $40 like it does, and this becomes the new normal, yeah, I think you're going to see production come back on, and I don't think it's going to be too fast. But again, only time will tell. And I think that's just going to lead into, and I don't know if this is going to be an issue maybe this week, but something to watch out is what does this mean for the refinery world? When we talked with Rob McBride, who's the senior director of smart things at Enverus. Their big analysis was the reason why we saw wild price swings and why you saw some of these regions like the Bakken getting hit worse than others was not due to the upstream factors, but more to the downstream factors. And refineries have been the one taking not the brunt of this, but have been basically the decision makers, and everybody else has reacted around it. And I think we've been seeing some stories over the past 3-4 days of refineries beginning to turn back on, but shifting what they're actually producing. So it'll be very interesting to see what happens with refineries. And as all this production comes back online, I think the refinery questions will be questioned, and we're going to get, we need to get somebody from the refinery side to come on, but we're going to talk with Steven on Friday and get a better idea of how this looks with the downstream, especially if we see this production stuff coming back online.
I agree. I got some folks that will get lined up. Excellent suggestion.
I love it. What's on the international news desk for this week? What are you watching for?
This week, South Australia kind of has some same problems of what's going on in New York. New York, I don't want to get into political things, but it sure is fun to poke at their energy things. This is an excellent opinion piece written by Tom Shetstone. The production of electricity by renewables does have blackouts. It does not, it's affected by the weather. So that is a major issue in one of our biggest cities and one of our biggest states is going to match to the same problems of what Australia's having. Until they start buying a large storage or they use natural gas, it's going to be an issue that we're going to watch. And South Australia had a very good article on that on the news desk. So, watching that is going to be quite outstanding. India had the lowest import of oil since 2005.
Wow.
They are gearing up their coal, the 41 that we ran last week, the 41 new coal plants.
Yep.
And they now have 6 LNG ports. They're bringing in energy, and it's now turning not to be crude. Big kind of way to hit that. So I'll keep watching that. Thanks, Michael.
Yeah, no, I think there's a lot of different stuff. Australia has been, on the international side, has been seeing a lot of movement, and we've been covering a lot of stories from that. And so we'll continue to follow that. I think as we look at the levels for the week, I sat down and created this overview document this morning. Time stands, it's like 8:18 in the morning right now. So all markets are open. S&P 500 is actually up a little bit. So all markets up about 0.25 percentage point. So that's good for the day. As always, natural gas flat. So we're not getting anything there on our 360 fund. But I was a little bearish. I really, it's when you look at price at, like I said, when I was putting the overview document together, I was a little bearish. I thought, $40 cap maybe is. And honestly, as I'm just sitting here, doing this podcast, as I'm kind of just looking at the charts, when you look at price action, it's hard to be bearish because price action looks bullish. Now, the reason why I like $40 as a cap is because it's more of a structural top than it is a technical top. I just think in terms of where the market, where I'm seeing the market go, I don't think I don't think $45 is going to happen this week. But
no.
I do on the chart that I published to the oil and gas desk. I've got a really nice long section from 38 to really 38.40. So if you are, while I might be a little bearish, maybe to end the week, I do think much like last week, we might touch 38. We might run back up to 40. And if we do see a depression, it might rip through. So if you are looking on the long side, I think what you can play right now is a pullback. I'd like to see it pull back a little bit. But, last week was what you want to talk about, a wild swing. If we're looking at straight up levels, I think the floor for this week, 35.35. I think the next level up, 36.78, 38.18. As I mentioned, that's my long pie. If I'm looking, if the charts look right and we're down in 38.18, it's a prime long position. I think 39.09 is another good level, 39.91, and then 40.25 is probably that largest volume top. But as we know, 40.56 is the actual top for last week, and that's the highest it's been pretty much since early March. So, like I said, it'll be very interesting. What's the Kreskin got for us?
Kreskin, the amazing Kreskin. I think that you're going to see 42.50.
Okay.
And the reason I say that number is we are continuing to have demand pull. People will be excited because of COVID. Who? You said that. COVID demand is going to create that.
Yeah, I was joking with Stuart before we started recording. I went out this weekend and COVID who? I mean, it was packed. I mean, you were waiting 10 minutes just to get into restaurants. Breweries were packed. So, yeah, it's COVID who? That's, I think, why I think, but that doesn't mean that there's, with these declines, I think are going to play a little big game. But yeah,
You're always right, Michael. Michael, you've got a higher track record than me, but I got some new. The old dog has a trick this week.
No, and it makes sense. So we're gonna have to slightly agree to disagree on this, but like I said, that's why we come back every Friday and we get to judge ourselves. What's up?
We're gonna bet $1, like in trading places.
We're gonna give me a $1. I like it. We're gonna hold us accountable here. I think let's move into the commitment of traders right now. Really interesting number was managed money or hedge funds got short and cut their long position. Now, what does this mean? People think, whoa, Stu, so people might think, oh, Michael, this bodes well for you. Managed money's getting short. No, not quite. They're cutting long positions, which means, you know what they're doing? Taking profit. Cashing in their money. They were long at $10 oil. They were long at $20 oil. It gets up to 40. You know what they do? Cha-ching. So, I mean, is 40, 42, 45 probably the cap for oil? Yes. I mean, I don't think, you know, I don't want to put words in your mouth, Stu. I don't think you're seeing $60. You're not saying $60 oil next week. But
No.
hedge funds are taking some profit, but they also aren't necessarily then getting short. So you saw 15,000 contracts get dropped on the long side, but only 3,000 get picked, 8,000 get picked up on the short side. So you're about double were dropped. So, I mean, they're taking more of an insurance play right now. What I tell you is they're dropping all of their long, and they're just taking out a little more insurance. But the market, at least from the hedge fund side, looks oddly bullish. So that bodes well for the Kreskin and your $1. But, like, we'll see what happens. As always, that ran from last Tuesday to Tuesday. So remember, there is a 4 or 5 day gap we are missing there. Anything else, U.S. oil, that I'm forgetting, Stu? I think I've covered it all here.
I think you did fantastic, Michael.
Awesome. So let's just go ahead and finish up with our 360 official, non-official fund. As always, the lawyers make us say this so we don't get sued. This segment is for entertainment purposes only. Everybody on the show, i.e. me, Michael Tanner, and Stuart Turley, we invest for our own account and do not manage any outside money. We do not give investment advice. We do not offer securities or have any involvement in the regulated side of the industry. Remember, investing is risky, and you can and will lose your entire principal. That being said, Stu, how's your side of the portfolio going?
Well, I'm still in Oxy for the short run. I'm probably going to get out today, but one of my favorites, LNG. I'm down just a little bit on that. There are some other updates on Henry Hub and stuff coming out this week. I am glad I got out of Devon, so I'm out. And Tomcat. He's playing some calls. He's having some fun this week.
Okay, so he's getting in. I mean, we'll let Tomcat plays the options games. Great. We'll have to see how that plays out. I look at my side of the portfolio. I tend to stay on the commodity side. I'm getting my shorts eaten on my natural gas. I mean, we're in at $1.79 for our 2 contracts. I mean, it's $1.68. So, I mean, I'm just going to continue to pound these experts who kept telling me I was going to make cash off that. But we'll see. I mean, like I said, I think 250 to 275 natural gas in the winters, not out of the question, but that's the long-term play. So I just like bugging week to week. Bonanza Creek's flat, which is sort of my other staple in the portfolio. We've got a nice little profit on that, though. In terms of what I'm going to do on crude oil this week, you know, I'm going to take out a short. I'm going to probably load up on the short side. We're 40.13 right now. Probably let it rise up. I like 40.25 is my cap. So we're probably going to get in. We're probably going to get in short at 40.25, see what happens, just because I'm going to put my money where my mouth is and load up our portfolio, see if we can make a couple day trades. But in terms of my bias, yeah, I don't know. It's mixed. I like getting long at $38. I like shorting now if you want to ride it down. But, you know, again, have a plan. My plan is to get in at 40, out at 38. So it can be as simple as that. But I think with that, that's about all I have for the show. I think we're going to go ahead and let you get out of here and get back to work. Thank you for checking out the 360 Digital Closing, but please remember to subscribe on iTunes, Spotify, and Entercom's YouTube channel. We will see you guys this afternoon for the Digital Ticker.